Hello, good morning. Welcome to the monthly market review conducted by ArthaYantra for the month of August. My name is Sudarshan, and I will be taking you through the webinar today. Nitin was originally scheduled to take this webinar. Unfortunately, due to family emergencies, he wasn't able to make it. So, without much ado, let's directly get into the session. So the webinar today, as followed in the previous webinars also, will follow a pattern. We start with the macroeconomy. We boil it down to the Indian economy to see how various asset classes perform, and then we arrive at the investment strategy. Now, the world economy isn't doing particularly well at the moment. Uh, there are signs of growth, but it's not particularly pleasing. So, for example, if you look at the USA, the GDP in the quarter that ended last June was at 1.2% annual growth. But for the same period last year, uh, compared to the same period last year, however, this was less than the 2.6% that was forecasted for this particular period. So that's a 1.4 percent point correction in what was forecasted, which means that it is not growing as much as you would want it to grow, but it is a growth nonetheless. The growth primarily was driven by household consumption, which is about 70% of the GDP, and the consumption itself grew by about 4.1% annualized rate. So this consumption can also be seen in how much the inventory has been eroded from the US market. So $8.1 billion worth of inventory was consumed by the USA. Now this is the first drop that the USA has experienced since 2011. Now, one way of looking at it is saying that the US companies are not really manufacturing enough, or they're not really, there's not enough demand for them to create enough of goods. But if you look at it the other way, it can be seen that there's $8.1 billion shortage of inventory, which can be compensated for over the next few quarters. There are signs of other improvements also. Like, for example, 255,000 jobs were added last July. The expectation was only 220,000. So we had more jobs added than expected. So this gives an indication that the U.S. economy is broadly stable, but it still needs more examples for it to be defined as proper growth. Next, we look at the euro area. The European Union and UK's separation was a very big uh, event that happened in June this year. The British referendum to exit from the European Union took place on June 23rd. Stock markets across the world crashed. Bond markets rose. The pound fell. However, if you look at it, it's just only a vote so far. No concrete action has been taken per se for Britain to exit the European Union itself. But just from the vote itself, it can be understood how severe the downside risks are. The actual process of separation of Britain from the European Union will probably take place in October of this year, when Britain must invoke Article 50 of the European Union Charter, which is the charter that binds the European Union by all its rules. And Article 50 specifies the process by which a country must exit this partnership. Last webinar, we had said that this is quite a disastrous outcome, specifically for Britain. And this can also be seen from the data which we have seen from June and July, specifically in the manufacturing PMI. When the PMI value is greater than 50, it means that particular economy is expanding. So if you look at the manufacturing PMI for England, for UK, it was at 52.4 in June, meaning manufacturing activity was expanding in June, but it fell below 50 to 48.2 in July, meaning manufacturing activity actually shrank. It's much less, far lesser than what it was in July. But if you look at it in the European Union as such, the composite PMI itself grew from 53.1 in June to 53.2 in July. The manufacturing PMI, it fell from 52.8 in June to 52.0 in July, meaning uh, it is expanding because the number is still above 50. It means it is still expanding, but it is just not as fast as it was in June, but it is expanding nonetheless. So even if there is a drop in the manufacturing PMI, the services PMI, meaning the consumption of the European Union, has increased, which is primarily what has driven the composite PMI to grow from 53.1 to 53.2. Now, from this alone can be seen that England was the wrong step to decide to exit the European Union, possibly hitting a recession. So, in order to boost the growth of the English GDP, the Bank of England cut down the interest rates by about 2.25% or 25 basis points, and it initiated a stimulus package of roughly about 445 billion pounds. This was to target private uh, company bonds and government bonds in order to boost liquidity and to boost production. The European Union, as such, had expanded 1.6% in the quarter from April to June. It is much faster than what the USA had expanded uh, for the same period. If you notice, USA had expanded about 1.2%, whereas the European Union grew at 1.6%. The other developed economy that we are concerned about is Japan. Japan, as you may be familiar with, has a very unique policy wherein the lending rates are negative, are below zero, and this is one of the very few economies that actually has that has taken such an adventurous step. Um, However, there are signs that this step was beneficial because the composite PMI had expanded to 50.1. And if you, as I said, if it is above 50, it signifies an expansion. So the composite PMI of 50.1 indicates that there is an expansion of activity in Japan. This is primarily driven by consumption. As you can see, the services PMI was at 50.7, while manufacturing activity shrank at 49.3. Now, the primary reason for the shrinking of manufacturing activity in Japan is because of the strengthening of the yen. Japan, as you may know, is known for exports. So most of the brands that you're aware of, Panasonic, Toyota, uh, Honda, are all based out of Japan, and these companies are a big driver of the Japanese economy, primarily through exports of goods. Now, with the strengthening of the yen, the price of Japanese goods goes up, and with higher the price, the lower goes the demand. With lower the demand, the manufacturing activity also goes down. With, so what the Bank of Japan and the government of Japan plan to do now is to weaken the yen. And to do this, they launched a stimulus package of 274 billion dollars. So these were invested to be invested in fields such as healthcare, uh, pension schemes, just so that uh, the average Japanese gets more money in order to reduce the value of the yen and at the same time increase the consumption of the average Japanese. So this will be panned out, and we'll have to see how well uh, this particular stimulus package will boost the Japanese growth. In emerging economies, primarily it is dominated only by China. China did not expand as well as we would expect. In the last 2, 3 decades, China has been a sort of the engine of the global economy. Uh, China became the center of manufacturing activity, and so it was able. You can find Chinese goods in almost every country, and almost everything was at one point made in China. However, global sentiments fell, consumption fell, and this reflected in the Chinese economy as well. It grew at only 6.7% in the quarter ending June. Now, if you compare this to the China of probably even 5 years ago, this is about roughly half of what their growth was back then. So, in order to boost the Chinese economy, China has invested in infrastructure through a stimulus package of about 4.7 trillion renminbi, or that's the equivalent of $722 billion. The emphasis on infrastructure would mean that there will be a higher consumption of iron, and you will have a higher consumption of supporting metals such as zinc and nickel. And that is why you have the value of these industrial metals rising up ever since the announcement of the uh, stimulus package by China. Now, another thing that China did was to reduce the value of the yen, so that the prices are much cheaper in the market, so that hoping for much more boosting in exports. So the renminbi, or the Chinese yuan, which had traded between 6.57 uh, to the dollar, meaning $1 will be equal to 6.57 yuan, was reduced on purpose to 6.65 to 6.67 in July. And this once again was aimed so that exports would be get enhanced. There are further stimulus packages that are happening in the Asia Pacific region. As we mentioned, one was Japan, the second was China, the third one more recently was Thailand. Thailand was under a political uh, crossroads of sorts. Recently, they held a referendum adopting the new constitution. And with this new constitution, there is hope of a stable economy, a stable government. And with the stability, we also expect that there will be a higher emphasis on economy. We expect that there will be an emphasis on infrastructure again, primarily uh, through rail networks to be developed across Thailand. Um, so while there is a stimulus package that will be initiated, Asian countries, that is Southeast Asian nations, that include Thailand, Malaysia, Singapore, Philippines, and so on, they will continue to have modest growth because they have a very high exposure to China. Uh, Almost about 15% of an Asian country's GDP is related to China, roughly. And as China is not doing that well at the moment, Asian economies uh, will not have a very high growth either. The other emerging economies of interest is in Latin America. Mexico's economy shrank for the first time in almost uh, 4 years. The Q2 GDP shrank by or reduced by 1.2%. However, we don't really expect it to go into a recession. Recession being two consecutive quarters of negative growth. Uh, this one-time reduction in GDP happened because there was a reduced consumption in USA. However, the economy of Mexico is expected to expand the coming quarter. The biggest economy in the Latin America nation is Brazil, and Brazil's exports are primarily commodities, and most of these commodities are purchased by China. Now, with China, which was running through a rather weak phase, the commodity prices fell, and this consequently had a negative effect on Brazil's exports, thereby reducing its GDP. So, China announced a stimulus package, and the commodity prices immediately rose up. And this will bode well for Latin American nations, such as Brazil and Chile. Chile being the largest exporter of film in the world. The other measures that Brazil has taken to boost its GDP is frugal measures. Basically, they are looking at cutting down unnecessary expenses to rein in their skyrocketing debt. So Brazil's economy shrank by 3.8% the previous year. However, it will shrink by 3.3% this year. Although it is a drop in the GDP, it is a sign that it is heading slowly towards growth. So we expect that measures such as those taken by the government to contain the debt, uh, the infrastructure investments that took place in coaching the Olympics, the boosting of the commodity prices due to China will all help Brazil's cause, and Brazil's economy will most likely expand by 1% the next year. Crude oil prices have been well, if you look at the crude oil prices from about 2 years ago to now, it's been a free fall more or less. So crude oil price was at 39 to $40 a barrel this at the beginning of August. Um, Consumption has not grown as much, and with the United States and the United Nations lifting sanctions on Iran for its nuclear proliferation, Iran has now the freedom to export a lot of oil. Um, so this boosted the amount of oil supply in the market, whereas the demand for oil actually fell. So the prices of oil consequently fell as well. Um, so there was also there were also reports of forest fires in Canada, uh, terror attacks in Nigeria and Libya, which had affected oil production. So for a brief while, oil prices did rally. Uh, However, there are signs that Nigeria and Libya are returning to normal production. So there will be once again an increased supply of oil to the market. So we don't really see oil gaining that much, uh, except for during short-term immediate shocks. Over the long term, we do not expect oil to reach its previous high levels of about 100 and $150 a barrel. So there was also a boost in the um, uh, oil prices briefly because of China announcing its stimulus package and reduced consumption. I'm sorry, reduced production in the United States. So besides this, the other commodities were, as we have discussed in with respect to the Chinese policy, metals like nickel, zinc, and tin they grew because of China's stimulus package. However, uh, if we look at copper, which we consider to be the barometer of the economy, so to speak, copper prices are still low. Until about a month or so ago, they were on a free fall. It's over the last month that their prices have actually stabilized and they look to remain flat. We don't really expect uh, copper prices to increase because there's also a surge in production, especially from countries such as Zambia and Chile. In contrast, The supply of other metals such as nickel fell because mines in Philippines, which accounts for about 25% of the world's nickel production, some of the mines in Philippines had shut down due to environmental reasons. So there is a supply shortage, and at the same time, coupled with China's increased demand for nickel, these have been contributing to nickel's increase in the prices. Uh, Bullion wise, China and Russia continue to be one of the biggest buyers of gold in the world. As of July 2015, the official reserves of China was declared to be 1,658 tons of gold, and 1 year later, uh, the reserve is about 108, 1,823 tons. So nearly about 200 tons of gold were added by the Bank of China. So this indicates that China is buying a lot of gold to hedge its portfolio itself. Besides this, the weak economic growth from the developed economies headed by US, the slowdown in the Latin America, all of these indicate that gold will continue to attract a lot of investment. So gold will will be expected to rally over the longer term, whereas in the shorter term it will be more or less range bound. Now, how all of this reflects in India? Well, India's quarter one GDP grew 7.9% year on year, so it still retains the tag of the fastest growing major economy in the world. So India's factory output had increased in July. So manufacturing activity stood at 51.8 in July compared to 51.7 in June, meaning the manufacturing activity was much higher in July and grew much faster compared to what it was in June. The monsoons, which are a very big part of uh, India's economy, had recorded 11% deficit in June, but it had eventually gained, and we had recorded a 6% excess in July. Now, with the extra monsoon, we expect there's a big boost in the consumption of the rural economy. Now, as we had mentioned before, gold prices, gold prices which were range bound, will be expected to climb higher in India because there will be a much higher demand for gold from the rural economy because of the increased consumption brought by the monsoon. The weak economic data of the US had dropped the value of the dollar as such. Uh, Recently, the US Federal Reserve was expected to was expected to discuss about the prospects of raising the interest rates, and that uh, and the meeting concluded saying that they will not be raising interest rates in the recent term. So this further weakened the dollar. So the rupee gained from this. So uh, at the time of Brexit, when the rupee was close to about 68 rupees a dollar, is now well above uh, 67 rupees a dollar. So as of 5th August, it was trading at about 66.7 rupees. Now, the stronger rupee and the prices being low overall in the market, um, India's exports, India's imports, sorry, will stand to benefit. And India, being a highly consumption-driven economy, will also benefit from this. The balance of payments will also improve because of the overall low prices outside and the strengthening of the rupee. One of the most significant events that took place over the last month is the passage of the GST bill, the goods and services tax, which has been pending for almost a decade now. It, had was passed on the 3rd August 2016. So essentially, the crux of the bill is all states are now unified by one common tax. Uh, so this will be highly beneficial to manufacturing organizations, especially when they are transporting goods from one state to another. They do not have to pay more. They do not have to pay more taxes and octroi. All of these will be replaced by a single GST. So earlier, to avoid paying some of these unnecessary taxes, manufacturing units had to set up units in different states to cater to that particular state's tax system, so that they could reduce costs at the same time make sales. Now, with the GST bill, there is a bit more of a freedom for goods to move relatively much more freely between states. So this the supply chain system of these manufacturing companies will be much more centralized. It will be much more cost effective. And with these costs, the prices of the goods also will drop. With this drop in the price of the goods, we can expect an increased consumption. So because of these, we expect the manufacturing activity to pick up, the consumption to pick up, and because this also benefits investments, we also expect investment through the Make in India initiative to pick up. All of these will contribute almost about 0.5 to 2% to India's GDP. However, the actual implementation of this GST will likely take place only by April 2017, uh, especially because of the massive amount of overhauling that has to take place, and at the same time, we also have to consider what the actual rate of GST should be charged, so that states benefit from the GST activity. However, uh, this GST rate has to be fixed in such a way that it does not increase inflation. And so, until the actual declaration of what the GST is, we will have to wait and watch. Now, as we had discussed earlier, the investment sentiment across the world has been rather bleak. We had the Brexit happening, we had the Greek crisis, we had the crisis of the Southern Europe, and before that we had the crisis of the housing bill. All of these kind of indicated that over time, uh, equity markets are being are highly prone to crash, and during such a time, uh, bonds become very attractive. But if you look at the bonds per se, the bond rates have also been falling. So if you have a look at Switzerland, see, for over a year they have been yielding less than 0% for the 10-year government bonds. Essentially, what this means is investors are paying governments themselves to keep their money. This does not add wealth to the investor as such. It actually erodes it. But yet there is a lot of demand for the Swiss bonds. As can be seen over here, high demand for the bond prices are high demand for the government bonds are driving up the prices of the bonds. Now, with the increase in the price of the bond, the yields also drop. So, for example, if you can look at Germany's 10-year bond yield the month of February 2016, it rose to 102 euros per bond, and correspondingly, the bond yield rate fell from 0.3% to 0.1%. Over time, we have seen that this bond prices continue to increase, and beyond a certain limit, Germany's bond yield rates fell to below 0%. Now the Swiss franc, the Swiss bonds are typically charged at about 100 Swiss francs per bond, and As you can see over here, in uh, the blue line shown under the Swiss 10-year bond yields, it indicates that the prices are way over the 100 Swiss franc mark. Consequently, the Swiss bond yield rates are always in negative. Now, the high bond demand is primarily due to the gloomy economic atmosphere across the world. More recently, as you would recall, in earlier this year, around February, there was a crash in the Chinese stock markets. This crash was split all across the world, and trillions of dollars of equities were wiped out. In order to protect themselves from such huge losses, investors buy government bonds because they're seen as a safe bet. So even though their bond yields are negative, investors perceive that it is still much better than investing in stock market. However, this is not the sentiment of all the stock market of all the investors per se. Um, Looking for yields, investors will buy bonds from emerging markets as well. And as you can see, the trend is pretty similar. The bond yield rates of Brazil, Indonesia, and India, emerging economies across different geographies, have all been dropping. This primarily is due to, once again, the high demand for the bonds, so that there is stability as well as there are returns. That said, um there are investors who continue to invest in equity markets as well. So, like for example, uh, on June 23rd, the referendum for the uh, uh, Brexit was being conducted. On the 20 was declared, and consequently, you can see that the stock markets crashed across the world. Hang Seng fell, DAX, that is the German stock exchange, fell, Nasdaq in the US also fell. But in a very short period of time, all of these had rallied to much before their pre-Brexit levels, and some of them even hit 52-week highs. If you have a look at the underlying macros, for example, you look at the Nasdaq's PYE ratio, we'll see that it was 19.08 on June 27th. That is immediately shortly after the Brexit referendum. It was at 19.08, meaning the price of the equity was not too high compared to the returns that the equity would give you. However, this grew to 24.4 in August 5th, meaning the price of the share which you're buying is either too high for the return it gives, or for the price that you're paying, the returns that you're getting from that particular share is too low. If you look at this, what we expect is we do not expect this rally to sustain, uh, especially when the P by E goes to such high levels. Similarly, you can look even in the Indian equity markets of Sensex and Nifty. They have also been tracking the global cues. They have also been rallied. They have also been rallying over the past 1.5 months. The P by E ratio of Nifty was at about 22.2 on June 27th, whereas this grew to 23.74 on August 5th. If you compare this with the global stock indices, as we had mentioned previously, Nasdaq had about 19.08 in June 27th and 24 in August 5th. So the prices are a bit on the steeper side. The Indian stock indices will face a bit of a correction in the short term because uh, there will be a lot of profit booking uh, with such a high P by E ratio. However, we expect that the rally will continue in the longer term, especially because the GST bill has been passed. The government is taking initiatives to rein in financial discipline, like through adoption of inflation targeting of about 4%. So we expect that the Sensex or the Nifty will be reaching new highs in the coming months. We expect 29,000 for Sensex and 9,000 for Nifty in the coming months. Going by all this, if you look at the investment strategy, even though the bond prices are falling, you it is still advisable for you to have exposure to bonds. Uh, you will be protecting yourself from high-level crashes that happen in stock indices, especially during events such as Brexit. And as we had mentioned previously, there will be a correction event of stock markets across the world, and that will get reflected in the Nifty and Sensex as well. So there will be a crash of sorts in the shorter term. During such a time, it will be more advisable for you to expose yourself to uh, uh, bonds. Like, uh, if you have had a look at the returns over the last year or so, uh, Sensex and Nifty compared to like 1 year ago have grown by probably just about 0.4%. And whereas your real returns came through bonds, in which case it would make sense for you to have exposure to bonds. Um, an interesting observation which we had made was that the uh, mutual funds that are backed by mutual funds that buy a lot of government securities had their NAVs expand during the time of Brexit, while while all the other stock indices fell. So, despite the low yield bonds, despite the dropping of the bond yields, it would still be advisable for you to have exposure to bonds. Equity markets, as we have discussed previously, will be range bound. Uh, so, in the immediate term, you may not get many. Your returns will not be that respectable, I guess. So, however, in the longer term, the Nifty and Sensex will rally. So, it would make sense for you to buy now and hold to the stocks for the longer term. And as we had said, there will be a correction of sorts in the shorter term. So what would be best now for you to buy the stocks now itself rather than wait for the correction to happen, because it is always easier. It is always better for you to hold rather than time the market. Gold exposure will, as if you have already spoken to your financial advisor, gold is good for your portfolio as a hedge. So whenever stock markets crash, your gold prices will rise. It acts as a good counterweight to whenever uh, such economic shocks happen. Now, as we had discussed previously, the bond exposure in the bonds in developed economies are not yielding as much. If you were able to catch a look at the numbers, India's 10-year bond yields was about 7%, whereas USA's was about 1.5%, and USA being one of the highest bond yields among all the developed economies. So even though the developed economy bonds are safe, it will not make sense for you to invest there because of the uh, low yield of these developed economy bonds. Underlying macro support in the global equity market is not particularly strong. So we do not expect uh, stock yields to be as much in the global equity market. So if you look at some of the underlying macros of the US, for example, the productivity of US actually is flat. Sales is not growing as much, and uh, because the sales is flat and the productivity is uh, uh, productivity is not as much, you will see the profit margins shrinking in some of these US-based companies. Consequently, you will also see that uh, the share prices of these US companies will also be range bound. So that said, it will be best for you to have a diversified portfolio, because for all shocks, it'll minimize the shocks in the longer run, and it'll also give you yields. So, in conclusion, the world economy is not healthy yet. There are quantitative easing events happening across the world. In Europe, you have the UK, you have most of the East Asian economies initiating stimulus packages. Uh, so, there is a lot of liquidity that will be happening in the market. However, the investment opportunities are not as much. Bonds are Bond yields are dropping across the world because of the very high demand for bonds. Uh, Equity markets over the past month have been attracting a lot of capital. This will potentially be leading to a bubble. There will be an unwinding event, which will be most likely in a couple of quarters. However, India's bond market, despite falling, is still giving very positive yield. And the underlying macros are also there to support India's growth story. Equity markets, as we have said, in the shorter run will be weaker in India, but over the long run, we can expect equity market to grow. In a rather bleak economic outlook, gold is always the trusted investment. So gold will continue to grow in the present dull economic environment. Having a mixture of equity, debt, and gold will be highly beneficial to your portfolio. Uh, Please talk to your financial advisor to know what would be the best combination of these that would be suited for you. Geopolitics and politics as such continue to dominate the global economic environment. Brexit was a recent example. Uh, Thailand's uncertainty in political environment had seen Thailand's economy grow only by 0.5% in 2015. Now, this is very, very low for any emerging economy. Similarly, there are upcoming U.S. presidential elections. If we have a Democratic victory through Hillary Clinton, we will expect to see the continued policies of Barack Obama. And if Republican candidate Mr. Donald Trump becomes the president of the United States, we will see a rather different approach to the U.S. economy. In the Middle East, we've had a discord between Iran and Saudi Arabia, and there's an overall uh, non-conformity between all OPEC members. So these are keeping the oil prices low. So in summary, politics affect your investments in some of the most uh, strange ways. So that concludes our webinar session for now. Uh, we'll now begin with our Q&A.